Hi there, this is Sean Broderick for UncommonWisdomDaily.com. Could crude oil be ready to break out to the upside? Take a look at this weekly chart. You can see that crude oil hit a 5-week high on Monday and is up against the top of the range that has held it in place since December. And yet there is a glut of oil on the market. Shipping analysts say around 100 million barrels of crude and about 25 million barrels of refined product are floating in supertankers off the shores of Europe, West Africa, Asia, and the U.S. Gulf. Meanwhile, the OPEC nations have cut their output by about 0.3% in April, and they're moving closer to those production cuts that they had targeted last year, but it's still not enough. Oil inventories, they're at their highest levels in 19 years, and global demand remains on course for its steepest drop since the early 1980s. Recently, the U.S. Energy Information Administration cut its forecast for 2009 world oil demand to 84.09 million barrels per day. So what's actually driving oil demand down? First, the global economy is shrinking, and second, us Americans, are driving less. The most recent government report from February shows that travel on U.S. roads dropped by about 0.9% year over year. That's 1.9 billion less vehicle miles. And yet oil goes higher. Some analysts say that people are pinning their hopes on things getting better as we go throughout the year. And that view is being reinforced by bullish news out of China, where the Purchasing Managers Index rose to 50.1 in April, and news from the U.S. that sounds pretty good in housing. We saw pending home sales, and we saw home construction both rise in March. However, I think it's more likely that oil is being used by traders to hedge against the slumping U.S. dollar. Take a look at this chart. A weekly chart of the U.S. dollar index shows that the greenback has put in a double top and seems to be breaking its recent uptrend. The dollar has been wild recently, so anything can happen. But the onus is on the dollar bulls to show that it can go higher from here. So how do you play this? Well, as long as you're aware that the oil rally could end at any time because the fundamentals don't really seem to back it up, I think you could play it using a stop. Let's look at a chart of the Energy Select Spider, or XLE. On top of this chart, you can see that the price of oil, which is a red line, and the price of the XLE. You can see they tend to track each other pretty closely. But the bottom of the chart, that's the ratio of the XLE to the price of oil. That shows that oil stocks are punished even more than oil itself in the pullback. That means they have a lot of ground to make up, and they could outperform going forward. Don't get attached to this rally. I don't think it will go on long term. But in the short term, oil stocks could do pretty well, and you could make a nice pile of gains. This is Sean Broderick for UncommonWisdomDaily.com. Thanks for watching.